In this video, we are going to be going over the LIFO reserve. So the LIFO reserve is an allowance account that's used to adjust inventory from a FIFO method of valuation to a LIFO method. So this allowance account that we will use to record our LIFO reserve is a contra asset account. So it's going to have a normal credit balance and reduce overall assets. So when we record our ending inventory under FIFO, so here's our ending inventory T account, our ending inventory is going to consist of the most recently purchased inventory. So say we had X units in the beginning, Y in the middle that we purchased, and then W units at the end. Let's say we sold 3 units, so we would have sold this batch of X, the 2 Ys, and then our ending balance would be made of this W ending inventory. So in a period of rising prices, this beginning inventory would have been the least expensive. Our purchase that we made mid-month would have been a little bit more expensive. And then our purchase that we made at the end of the month that comprises ending inventory would be the most expensive. So our ending inventory under FIFO is going to be more expensive. Under LIFO, so if we had done the same scenario, our ending inventory would consist of the X and the 2Y units of inventory. And so these were the least expensive. So when we are comparing our FIFO ending inventory to our LIFO ending inventory, we need to reduce our FIFO ending inventory to get down to the LIFO. So the way that we do that is through an account called the allowance to reduce inventory to LIFO. So allowance to, also known as the LIFO reserve. So the LIFO reserve, as we mentioned before, is going to be a contra asset account. So it's going to have a normal credit balance. So we have a beginning balance in this account generally if we had a difference between our FIFO and our LIFO ending inventory last period. And then our ending balance in our LIFO reserve account is going to be based off of a calculation. So our desired ending balance in our allowance account should be the difference between ending inventory under FIFO and our ending inventory under LIFO. Then we're going to take the difference between our beginning and our ending balance and see how much we need to credit to this account in order to get to our desired ending balance. So this credit here is a plug. So it's just based off of our desired ending balance. And we are going to charge this to cost of goods sold. So then when we report our inventory on our balance sheet, we'll have our ending inventory under FIFO. We'll subtract our allowance to reduce inventory to LIFO, and that will give us our ending inventory valued under LIFO. So our entry to increase our allowance account to the ending desired LIFO reserve balance, we are going to debit cost of goods sold and then credit the allowance account. So this is going to increase the cost that we are going to recognize on our income statement as our expense of selling. So let's go ahead and jump into an example. So for this company, they use the LIFO method for financial reporting, but FIFO for internal reporting. So if we look at their internal inventory T account, our ending balance in our inventory as of December 31st, so our year end was 2.9 million. So this is ending inventory under FIFO. Then we're told that for external reporting purposes, the LIFO inventory balance would be 1,500 at the end of the period. So if we take the difference between our FIFO and LIFO ending inventory balances at the end of the period, we'll get a difference of 1.4 million. So this is what we need to have in our LIFO reserve. So if we take a look at our LIFO T account, or sorry, our LIFO allowance T account, our prompt lets us know that as of January 1st, 2025, so the beginning of the year, the LIFO reserve has a credit balance of 1,300. So our beginning balance will be over here on the right side representing a credit balance. And then our ending balance is what we calculated up here. So this is our amount that we need to get from FIFO to LIFO. And so that's going to be our desired ending balance. So we'll put that down here, 1.4 million. And then we take the difference between our ending balance and our beginning balance and see what we need to do to this account in order to get our desired ending balance. So here we have 1.3 million. We need to get up to 1.4 million. And so we are going to credit our allowance account for $100,000. And that is going to be a credit to our allowance and a debit to cost of goods sold. So we record this by debiting cost of goods sold and then crediting our allowance to reduce inventory to LIFO account. So then when we report our ending inventory on our classified balance sheet at the end of the period, we will report the net amount. So we'll report the ending inventory under FIFO, less the amount in our allowance account, so the 1,400, which will give us a net ending inventory valuation of 1.4 million, which is equal to our value of ending inventory under LIFO.